Today, I'd like to talk again about the Supplemental Leverage Ratio, SLR. We've done multiple videos on this now for over a year, and today I want to go over what's going on because it seems that we're coming to an end. The question is why is this coming to an end? And only you can make up your mind on that. So after the great financial crisis, we instituted the SLR for our big banks, our GSIBs. And we have 8 of them, and there's 29 in the world. And the first paragraph encapsulates it. We did it to limit excess leverage in our large financial institutions, particularly U.S. globally systemically important banks, GSIBs. Now, the key feature is, unlike risk-weighted capital ratios, Basel III, Tier 1, Tier 2, and Tier 3, it treats all assets on the balance sheet exactly the same. Remember that. SLR treats all the assets exactly the same. So there's no difference between, let's say, a CDO and treasury bills, okay? So during COVID, we suspended the SLR to encourage more lending. And now there's a discussion on what should we do with SLR. And it is a crucial anti-leverage tool. And, what are we going to do with this? So last year we made our first video because the SEC, or the Treasury, was terrified that the banks and the hedge funds participating in the auctions may not be able to pay for their treasuries. And since the hedge funds and the private equity guys were excluded from the SLR, they have no ratios whatsoever, they do whatever they want. The SEC and the Treasury was trying to get the same SLR requirements for hedge funds that they had for the GSIBs. Now, the hedge funds were totally against us, 1,000%. They were like, no freaking way this is happening, all right? And on the other hand, at the exact same time, while the Fed and the Treasury is trying to get the hedge funds under our thumb, the banks, the 8 banks, send a letter. They send a letter to the OCC, the Federal Reserve, and FDIC. And they say, listen, unless you get rid of SLR for treasuries, we're not participating in any auctions. Okay, that was last year. And so this has been fought in the background all this time, all right? But now times have changed just a little bit, right? We've seen in the last 2 weeks that our long end of our bond market is under attack. Now, when I say ours, I should also say all the bonds. If you look at the bond complexes around the world, all the long ends are going up. What does that mean long term? I don't know. We're all going to figure it out. But it seems at this particular time that we are stressed on the long end of our bonds. And that we're not the only ones. We know Japan's the same way. Everyone's facing some kind of issues. Europe, everybody, okay? So it seems that our government, and when I say our government, I'm talking about the Treasury, the Federal Reserve, and the FDIC and the OCC, have all come to an agreement on the SLR. And as you can see from an article yesterday, I believe this was, Percent says that the SLR moves are very close. And what moves are we talking about? So this is underneath that caption I just showed you, okay? Here's the first line. The U.S. government debt held on to slight gain after Treasury Secretary Percent said that plans for deregulation were gaining momentum, all right? All right, now, I'm just saying, we have 3 things that you can read into what the government's doing and why they're doing it, all right? And this is what we have discussed many, many, many times, that when we have an issue, the Fed comes up with a facility. Usually it's some kind of liquidity facility. These liquidity facilities, hopefully they have diagnosed a problem and created a liquidity facility to take care of that, right? Our bank term funding program, BTFP, after this SVB went belly up, was to take care of a specific problem, and it did it. It was a liquidity facility, all right? So, as they've said in DeepSeek, this issue has nothing to do with regulation. But this is what Scott Bessent said. But when you go down lower into this article that quotes Bessent, he says that by doing this, it is likely to bolster demand for treasuries, especially relative to interest rate swaps, and improve liquidity in the market. Treasuries outperformed similar maturity swap contracts Friday after Bessent's comment. Now, the last paragraph is critical here. It's not a government official. And he says, but the banks are unlikely to be marginal buyer of treasuries when the auction sizes go up to finance the deficits. So what is he saying here? He's saying that, look, even if we get rid of the SLR, and what does that actually mean? Here it is in plain English. They can buy the treasuries with no money down. Zero. No money. We're issuing $58 billion in auctions this week, right? Whatever. These banks can buy it, no money down. That's what it means. So think about it. 1 year ago, they're trying to get the hedge funds to put up the same SLR as the banks. And now we're saying, hey, forget the hedge fund, even the banks, no money up. You don't have to put any money up. Just take the bonds, all right? And even though that's the case, look at what the guy said. Its odds are they're not going to increase their buying of treasuries on the auctions. So here's the three things we're going to address today. One, is the government doing this for deregulation? Because it's their big thing. We're going to deregulate, the economy is going to grow, and that's why we're doing the tax cuts, okay? That's one thing, okay? The second thing is that they can't include the hedge funds, so why include the banks? And no one's going to pay for our treasuries. So the question is this giving us more liquidity to our institutions to buy the treasuries? So for our hedge funds, no, they've been putting no money up since day one, right? On the other hand, our banks have, and they're saying now that you don't have to do that, right? So what's likely to happen? Well, last year when we did this, and I'll post as many, there's 3 or 4 of them, on the SLR, the banks were very clear. They wanted the SLR to go, and they didn't want to participate in it, but they didn't want it for this reason. If you buy the treasuries, there's only X percent, very thin margins that you're making on them. That's not good enough for them. They'd rather go out and buy the triple B minus D, derivative and everything and make 50%. Why should they make 5% when they make 50%? So they want that capital that they have to give to the treasuries so they can go invest it in higher yielding, and higher yielding is more risky assets. That's the whole thing from the banks. The banks in no way are saying, here, get rid of SLR so we can buy more bonds. They want to get rid of SLR so they can go invest the capital that frees up in more risky items which have a higher yield, and that's what they want. Also, they had R.C. Whalen. It's R. Christopher Whalen, I think. He's a longtime bank analyst. He's very, very good. If you don't follow him, you should. He came out last week and says he's talked to all the bank executives about this SLR, which he thinks is a little unnecessary, but was put in after the great financial crisis. But here's what he said. He said, all the banks have told them they want that capital so they can buy back more stock and pay more dividends, which would drive up the price of the stock and drive up their pay, all right? So 3 things. Are they doing it for deregulation? Are they doing it so that banks can buy more, right? And third, are they doing it so they can go invest in more risky stuff? Now, listen, our swap market is under stress. And this is one of the things, and you saw it in in the beginning of this article. Here in the 3rd paragraph, you can see it's likely to bolster demand for treasuries, especially relative to interest rate swaps. Our swap market is under stress, and this is something that they're trying to solve for. So will this solve for it, or will this just give us higher dividends and higher stock buybacks? Tell me in the comments, like and follow.